Hi everyone. Today I'm going to talk about the preparation of the statement of cash flows. I'm going to introduce the two methods, the indirect method versus direct method. In Canada, indirect method is the most common method that has been used in practice. However, it's still important for us to know about how to do it in the direct method. So in this video, I'm going to show you how to use both methods to solve a simple question. Okay, let's move on. Okay, so we are going to use this information from a hypothetical company, ABC Incorporation. Okay, and we have the information provided on the left of the screen. Okay, so this is a company. We have sales, $1,000, cost of goods sold, $600. That gives us the gross profit of $400. And then we have a bunch of expenses. Operating expenses, $200. Interest expense, $10. Depreciation expenses, $30. Okay, so then the gross profit deduct all these expenses. Okay, the expenses in total $240. I have income before income taxes, $160. And you have income tax expenses, $40. So your net income is this difference, $120. Okay, so very simple income statement from the ABC Incorporation. During the year, we have some information about the statement of financial position. Okay, so they told us a bunch of the current assets and the current liabilities, how that accounts changes. So accounts receivable decreased by $20. Inventory decreased by $200. Accounts payable increased by $15. Prepaid expenses increased by $5. Income tax payable decreased by $3. And interest payable increased by $2. Okay, so that's the information. We know about net income, and we know about the changes in the current assets and the current liabilities. Okay, so how we are going to prepare the statement of cash flows using indirect method. Okay, indirect method. So we started from net income. Okay, so the net income is 120. Okay, so we start with this number, and then we add depreciation expenses. Okay, because this depreciation expenses is a non-cash item. Okay, so we want to add this back, $30. So now we are going to consider the adjustment on the working capitals, the current assets and the current liabilities. Okay, so we have decrease in accounts receivable. So your balance of the account receivable decreased. That means you are collecting accounts receivable, so you are converting AR to cash. So if the balance of accounts receivable decreased, that means your cash will increase by 20. Okay? Decrease in inventory. So your inventory decreased by $200. Okay? So again, that means you are selling these inventories, right? You are selling the inventories for cash, right? So basically, you are converting the current assets, AR and the inventory, into cash. That's the reason why these balances decrease. So your cash will increase by 200, okay? Next, increase in AP, right? So your accounts payable liability balance increased by 15, that's going to help you save money, right? So when you made the purchase, instead of using cash, you used credit, you used the accounts payable, right? So if your accounts payable balance increased by $15, so you save $15 cash, right? You save $15 cash. So that would help you to have a larger cash. So that increase $15, okay? Prepaid expenses increase by $5, okay? So prepaid expenses, that means you have to pay these expenses now, even though you haven't used the service yet, right? So in this case, you are paying the cash, right? You are paying the cash. So your cash decreased by $5, right? Decreased by $5. Income tax payable decreased by $3, okay? Income tax payable decreased by $3. So you are using cash to settle the liability. So income tax payable is a current liability. If that balance decreased, that means you are using cash to settle this liability. Okay, so the cash balance decreased by $3. Interest payable increased by $2. Interest payable increased by $2. So increase in interest payable, so your liability increased, okay? That means you save your cash on your side, okay? So you plus $2. Okay, so if I sum all these numbers up, okay, 20, 200, 220, plus 15, 235, minus 5, 230, and minus 3, 227, plus 2, 229. Okay, that's the sum of these numbers together. Okay, so now the cash flow generated from operating activities would be 379. So 120 plus 30 plus 299. So you get 379. Okay. So this is most likely how you have learned to prepare the cash flows from the operating activities for the statement of cash flow in the introductory financial accounting. Okay, in the introductory financial accounting. So once we are started learning about intermediate financial accounting, we are dealing with International Financial Reporting Standard, IFRS. Okay, so IFRS have particular requirement for the statement of cash flow. Okay. So in this slide, on this table, so I'm comparing the two common standards used in Canada. So IFRS, okay, this is used for the publicly listed companies. ASB, that's used by the small, medium-sized enterprises, right? So let's compare, okay? Let's compare the differences between the two financial accounting standards, okay? For title, so under IFRS, we call it statement of cash flows. And the ASB is called cash flow statement, okay? Just some kind of subtle difference in the title. And disclosure of income tax paid required, okay? Under IFRS, IFRS require the income tax paid, right, to CRA, right, to be disclosed. So you're gonna have one line in the statement of cash flows telling your user what is the amount of income tax paid, okay? You have to separately present this information. Under ASB, that's not required. That's not required, okay? Okay, separate disclosure of interest and the dividend paid. So under IFRS require a separate disclosure of interest and dividend paid. Okay, so if you have interest paid to the bankers, okay, to the creditors, you have dividend paid to the shareholders, those information has to be separately disclosed in the statement of cash flows. However, under ASB, okay, that's not required. That's not required under ASB. Okay, unless the interest or dividend is directly charged to retained earnings. Okay, so for example, under ASB, if you issue the dividend to shareholders, so if you remember the journal entry, you are going to debit retained earnings, right? You're going to debit retained earnings. So in that case, you have to disclose dividend paid to shareholders under financing activity, okay? Under financing activity. Move on. For interest and dividend received, right? The company corporations may receive interest income, dividend income from other parties. Okay, so IFRS require interest income received, dividend received has to be separately disclosed. Okay, and this is not a requirement under ASB. Okay, and moving to the bottom item, how this interest and the dividend items should be classified. They should be included under operating activities or financing activities. Okay. So under IFRS, this is flexible. So the companies have the flexibilities to choose either ways. Okay. It's their policy whether to report it under operatings or financing. Under ASB, okay, the dividend and interest received, okay, the income plus the interest paid, this normally presented under operating activities. The dividend paid is under financing activities, okay? So under IFRS, there are rooms, there are flexibilities. Okay, so I want you to walk away from this slide knowing that under IFRS, we need to disclose income tax paid, right, to CRA, the interest dividend paid, right, interest paid to creditors, dividend paid to the shareholders, and also interest received, okay, and the dividend received. So this all has to be separately disclosed, okay? Now, back to our example, okay? You can see that we haven't disclosed income tax paid, right? We haven't disclosed the interest expenses paid, right? So we have to do that under IFRS, right? So how are we going to make changes to this template, okay, to make it fit into the IFRS? So first of all, we want to consider interest expenses paid, okay? So interest expenses is different from interest expenses paid, right? When you say you paid something, that's the cash flow, right? When you mention the interest expenses, you accrue that expenses. So that two numbers may be different, okay? So let's take a look. We are going to first, okay, add back interest expenses because this is not considered as cash flow, right? You add back interest expenses, $10, and then you want to show what's the cash outflows for the interest paid, okay? For the interest paid. Interest paid should be $8. So you may wonder how I got this number. $8 for the interest paid. Okay, so there's a reason why I mark this line as a black in the blue color to match these two lines. So increase in interest payable, increase in interest payable, okay, by $2. Okay, so basically what happened is when you recognize interest expenses $10, if you didn't pay for this at all, your interest payable should increase by $10. Correct? Think about it. If you recognize the expenses and you didn't pay it at all, okay, you didn't pay cash at all, so your interest payable should increase by the same amount, by $10, right? However, when we were told the interest payable increased only by $2, so we can infer that actually you paid $8 cash, okay? So you paid $8 cash. So interest paid is $8. So basically 10 minus 8, that's number 2, right? That is the number 2. Okay. See, now we singled out this line for interest paid, $8. Okay. Does this make sense? Now let's move on to income tax expenses paid. Income tax expenses. So now let's focus on the red color here. We add income tax expenses, $40 back. Okay, we add back. And then the income tax paid should be $43. Why? Again, back to this line, the red line, decrease in income tax payable. Okay, so think about this. If you recognize income tax expenses, $40, if you didn't pay at all, if you didn't pay anything in cash, so your income tax payable should increase by $40. Okay. However, in this case, we were told that income tax payable decreased by $3. That means you have paid more than 40. You paid 43. Okay. So you recognize $40 income tax expenses. So your income tax payable should increase $40. But the fact that you paid income tax, okay, you use cash to settle this liability for $43. So the net effect is your income tax expenses payable, so income tax payable should decrease by $3. That's this one. Okay? So now I have both items singled out. Interest paid, $8, and income tax paid, $43. So that's good. This is required by IFRS, right? So now I only have these 4 items left. If I add them up, 20, 215 minus 5, I should get 230. Okay, I should get 230. So if I sum up all these numbers up to 230, that is the cash flow generated from operating activities. So if I sum up all these numbers, I should get 430. So we call this number cash flow generated from operating activities. And then $8 paid for interest, $43 paid for income tax. My net cash from operating activities is $379. Okay, $379. So this is kind of different from maybe what you have learned in the first introductory financial accounting course. Under IFRS, we are required to separately disclose interest paid and income tax paid in the statement of cash flows. Okay. All right. So this number is the same, 379. In the first, in this model, so the number is 379. Okay. So the end result is the same. It's just we need to separately present. We need to separately present interest paid and income tax paid. Okay. All right. Move on. Now let's think about how to prepare the same statement of cash flows using direct method. Okay. All right. So when it comes to the interest paid, income tax paid, these items, these numbers is determined in the same manner. Doesn't matter whether it's direct or indirect method. So these numbers will stay the same. Okay. Under the direct method, okay, we first want to know what is the cash received from the customers. Okay. How much cash I received from the customers? So during the year, you made the sales, right? So basically you made the sales, you have some cash sales, right? So the cash sales is what you have collected, right? From the sales. And you also collecting AR, right? When you are collecting the AR, accounts receivable, you receive cash, right? So that's the two component. So to calculate cash received from customers, we are doing this by using current year's sales. Okay, this is the total sales minus change in account receivable. Okay, change in account receivable. So when I refer to change, I mean the ending balance minus opening balance. Okay, that's very important. So when I talk about change in account receivable, so I mean the ending balance minus opening balance. Okay, so sales in this year is $1,000, right? 1,000 here. Change in AR. We have that information. AR decreased by $20. Decreased. So your ending balance is less than beginning balance. So the change is a negative, right? That means decrease. So 1,000 minus the change, which is negative 20. So two negatives, you get a positive. So you get 1020. So that's the cash receipts from customer. Okay. Cash paid for inventories. Okay. This company is a manufacturing company. You can see cost of goods sold. So it's you had to purchase inventory, right? You had to purchase inventory. So how much cash did you pay for the inventories? So the number here is 385. How did I get this number? Okay. Remember the purchase, right? When you think about the purchase of inventory, back to the intro financial accounting, it's about cost of goods sold, okay, plus change in inventory. That is a purchase. Okay, if you remember the inventory equation, okay, so here, okay, here, the cost of goods sold, and then you plus change in inventory, this is the purchase, the amount of purchase, and then you minus your purchase using your credit, that's the change in AP, and that's the cash purchase, right? That's the cash purchase. Okay, the first two component, cost of goods sold plus change in inventory, this is purchase. Okay, this is the purchase, total purchase. Okay, and then you consider the purchase on your credit, the change in accounts payable. The difference minus this, the difference is the cash purchase, right? Okay, so cost of goods sold is 600. Change in inventory, ending inventory minus beginning inventory. So no, inventory decreased by $200. Okay, decrease, so the change is negative. Okay, so that's 600 plus negative 200 and minus, what's the change in AP? So AP increase, okay? When you increase, the change is positive. So that's the positive 15. So 600 plus change in inventory, negative 200, and minus change in AP, that's minus 15. So this number should be 8,385, okay? And because this is a cash paid, so here it should be negative 385, okay? Now, cash paid for operating expenses, okay? Cash paid for operating expenses, 205. Okay, why is that number? Okay, so you have operating expenses plus change in prepaid expenses. Okay, change in prepaid expenses. Operating expenses is the expenses incurred during this reporting period, right? The prepaid expenses is what you have prepaid, right? You have prepaid. So we have here $200, okay? Operating expenses, $200. The change in prepaid expenses, okay? So that's an increase, $5. So you're gonna add $5, okay? You're gonna add $5. So if you prepaid more, that means you are spending your cash, right? So it's 205. Okay, so if you do a calculation, 1020 minus 385 minus 205, you should get 430. Okay, and these two items remain the same. We mentioned doesn't matter whether it's direct method or indirect method. The way how we do the calculate these two items are the same. So you ended up with 379. So regardless the methods, right, direct versus indirect, you should ended up with the same number, 379. Okay, well, I hope you have learned about the differences between direct method versus indirect method. Okay, so the big difference is direct method, you are trying to understand where the cash go, right? From customers goes to the suppliers, right? Under the indirect method, you do this preparation based on net income, okay? Based on net income. So I hope everything is pretty clear. So I hope that you will enjoy this video. Okay, thank you.